Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
One of the top traders, PR Sundar, now joining us on the show today. Sundar, hi, good afternoon. Sundar, of course, hails from Chennai. He used to be a teacher and now full-time trader. And if you've seen his worksheet which he puts out almost on a daily basis, he's been making a lot of money. He's mainly in options on Nifty and Nifty Bank, and mainly on the sell side because closer to expiry. Because you have to take the other side. I just want to tell our viewers that what we're doing right now is just trying to tell you that while it's a tough game, it can be mastered, and but you will need a lot of discipline to master this. Of course, Sundar has been doing for some time now. Sundar, hi, good afternoon.
Good afternoon.
So for our viewers, first tell us the basic strategy of option trading, because we see a lot of people buying option at 3 rupees, 4 rupees, hoping that they'll become 50, 60, and they end up being zero. So what is the basic strategy?
Okay, generally people say option buying is like gambling and option selling is like running a casino. So as you have mentioned very clearly, running casino is not for very small people, and it has got its own risk also. And what normally we do, we based on our fundamental analysis and technical analysis, we decide a range and we sell a put option and a call option. Say for example, what I did yesterday, I sold 26,500 put option and 26,800 call option. I collected a premium of about 140 rupees. And today, both are likely to go to zero. But Bank Nifty tend to make a violent move after 3 p.m. So whatever we do, we just keep doing from morning 9:15 to 3 o'clock. Then after 3 o'clock, we just put a stop loss for all our positions, and we just wait. Okay, and then like sometimes once the trend is very clear, even after 3 p.m. also we tend to make some positions.
Okay, so for example, let's just pull out some of these call options, 26,000, or rather let's pull out the put options, because today we started on the way down. The market, and we have 26,200, 300, 400, 500 puts. They've all sort of become zero. Now the issue here is if you would have sold these options at, say, at the start, 14 rupees on 26,200, 22 rupees on 26,200, they've all become pretty close to zero. But it's easier to see this in hindsight now, Sundar, right?
Yeah, right.
There's always a risk that it goes completely against you, and when you're selling an option, the risk is unlimited. So how do you mitigate that risk in that case? And how should a retail trader mitigate that risk?
Yeah, see, generally what happens, option buyers are lured by the people by saying that it has got limited risk, and then, limited margin money, and then very high reward. So let us say if all three factors are favoring the option buyer, logically speaking, everybody should be on the buy side.
Exactly.
But the fact is that most of the people hide the fourth dimension, the probability of winning. So if option buying is a limited risk and limited money and unlimited reward, you can go and buy a lottery ticket. You just buy for 10 rupees, you can get even 1 crore. And although they say it's unlimited profit, in option buying, like sometimes you buy for 10 rupees, it becomes 20 rupees or 30 rupees or maximum 50, 100 rupees, not more than 10 times. But most of the time they tend to go to zero. But option seller, okay, he has to manage his risk very well. And most of the time, option sellers are the institutions and HNI clients, and they know how to manage the risk very well.
So, for example, for today's trade, of course, now there's not too much time left for weekly options expiry. If, in the morning you sold the put options, right?
Yes.
But if the market would have had a trend day, in that case, how would you have sort of hedged yourself in that case?
And see, that is, you said, how you would have done the hedging, right? The most important thing for all the option sellers is a facility for hedging. Option buyer cannot do the hedging. Either you can put a stop loss, you can come out, or you lose your entire capital. But what happens, you sell the put option, and if you feel that the market is really going down, you can continue to sell call options. Right? So when the market goes down, you sell call option. When the market goes up, you sell put options. So you manage like that. At some point of time, being the expiry day, the theta decay will be very fast.
Okay.
Right? And then, at some point of time, you also keep certain stop loss in your mind.
Okay, so before the show started, you showed me you I think sold 26,700 call for today.
Yes.
What was the premium that at which you sold that call?
I sold 26,700 call at 30 rupees, 26,800 call at 10 rupees,
Okay.
and 26,400 just 5 minutes before, 10 minutes before I showed you, I sold it at 8 rupees around. Now trading around 1 rupee 50 paise.
Okay.
And then 26,300 around 4-5 rupees, and 26,200 around 4 rupees, and so on.
Okay, and again, once again, for people listening in here, you will require a lot of margin, though. It's not a game for everyone. You will need a lot of margin. For those who don't have the margin, in that case, this game is not for them, right?
Yeah, true. But the thing is, since it is an intraday trade, and a lot of brokers will be offering a good amount of leverage. Say my broker offers me about 10 times leverage. So if I got 1 crore money in my account and he gives me 10 crore, and with that 10 crore, I can just sell a lot of put option, call options, and far away 2 rupees, 3 rupees, and at the end of the day, I make 2% of my capital. Right? So if you are making 2% per day, in 4 expiries, you make 8%. 8% per month, for an HNI client like me, it's a very huge money.
Okay. So again, for our retail viewers, Sundar, tell us what should be the mistakes that you should be avoiding in option trading.
And see, option buying is like it is a hero or zero game.
Yes.
Right? And most of the time, the people do not realize that. Say, for example,
for example, on 31st May, if you were selling call options, market would have taken you cleaners, right? Because you had that 700-point intraday rally. So how do you hedge that? Because for any stop loss, that would get triggered.
Okay, see, that's number one. You're asking me, those who have sold call option would have lost heavily. But the same question I'm asking, what would have happened to all those who bought the put options? And everything is, even deep in the money put options, but where it became zero. So it's a 50-50%. Right? And like once in a while, I always say, like somebody is coming into my casino, is winning a big prize money. It's always good. Only that motivates those people to come and again lose.
So once again, for indices, you mainly sell options, but for stocks, it would be prudent to buy instead of selling options?
Yeah, generally people who are selling options, the institutions and HNI clients, they do huge volume. Sometimes, the stocks may not take the kind of volume that we do. That's number one. And second thing, option seller always wish that, the market is range bound so that he can make profit. But sometimes, stocks can tend to move violently. And in fact, you mentioned on May 31st, and that violent move came because of the news about HDFC Bank. So sometimes, stocks tend to move, so it's better to avoid.
Okay, finally then, for this expiry, is there any last trade that you think is still doable?
Yeah, now it's almost 3 o'clock. Now from now, the weighted average take place, right? And usually 3 to 3:30, there can be a violent move. And if there is any move, I expect it on the higher side rather than on the lower side.
On the higher side, you said,
Yes.
is a possibility. All right, Sundar, thanks a lot for joining us.